Hello and welcome, I'm Suyash Maheshwari and you are watching Last Tick here on News 9, where we bring to you the lowdown of the day's action on the Lal Street. Now, Indian markets witnessed one of its worst crashes in the last 1 year as Nifty declined by over 2%, extending its losing streak to 2 sessions now. At close, Nifty was down somewhere around 460 points or 2.09% to close at 21,571 mark. Now, these are the lowest levels since January 9 of this year. Sensex also gave away somewhere close to 1600 points, in fact more than 1600 points, to close just marginally above the 71,500 mark. Now, with today's fall, the markets overall have turned negative for 2024. Nifty till yesterday was up somewhere around 1.5% on a year-to-date basis, but after today's sharp correction, let's call it a bloodbath because that's what we saw, it's down somewhere around 0.8%. And I think what's more worrying is the fact that we did not see any recovery throughout the session. In fact, the headliners ended very close to the day's low. In Nifty's case, just about 20 points off from it. Now, this could indicate that there is more weakness to come in the next few sessions going forward. Now, overall, the correction was also seen in the broader markets, but they still managed to fare better than the headliners. Now, Nifty Midcap 100 was down 1.08%. It ended at 47,151 mark. The small cap index fell about 1.2% and settled just below the 15,350 mark. India VIX, the fear index, saw a massive spike of 11% in today's session and ended above the 15 levels. Now, this is the highest close for India VIX this year and the highest close since December 28 of 2023. Now, what led to today's sharp crash? Now, I think the biggest drag on the markets was the shares of HDFC Bank, which has a weightage of about 14% in Nifty. The stock witnessed its worst fall in 3 years following its December quarter results. Now, despite the headline numbers coming pretty much in line with what the street was expecting, investors appeared unimpressed by the outlook on loan growth and margins by top brokerages. Now, top brokerages like CLSA and Morgan Stanley red flagged loan growth and lower liquidity coverage ratio for HDFC Bank. The Bank Nifty also had an expiry day today, so perhaps that adds an additional layer of significance to the market movement that we saw today. Another bearish factor why the market saw a correction was that we are seeing some bit of a correction in the global markets as well after the US Federal Reserve said that pretty much that the rate cuts are not going to come in as quickly or as early as the investors were earlier hoping for. Now, Fed Governor Christopher Waller suggested that while the central bank will likely cut rates this year, it may take some time, it may come pretty much at the latter half of the year. Now, according to CME's Fed Watch tool, market expectations of rate cut in March has eased to 62.2%. Chances versus about 79% which we had witnessed in the previous session. This commentary also prompted the 10-year treasury yields to gain somewhere around 10 to 15 basis points, and they are back above the 4% mark. The US dollar index too hovered near the 1-month high of 103.3 levels, and this is again, as I mentioned earlier, one of the biggest rises at the spike in the dollar index since the last 1 month. But to discuss what happened in the market today, let's also bring on board Mr. Ambrish Balega. Now, thank you for joining us, Mr. Balega. Always a pleasure speaking to you. And coincidentally, in the last few times that you have joined us here on News 9, it's been on days of sharp corrections. Last time you were here, Nifty was down somewhere around 200 points. Today, it fell somewhere around 400 points. And you, for one, repeatedly have said that the market needs a major correction before it can resume that next leg of up move. Is this it, or is there more pain left for us in the offing?
I mean, I was about to say that because I was just looking back and saw that every time I appear on a channel, it's just after a major fall. I think the last 2 or 3 times it's happened. But I just hope it's just a coincidence and may not happen next time. As far as the markets are concerned, yes, I think this fall was overdue. And I think like I've been saying, the valuations were very high and possibly it required a reason to fall. And the reason came in terms of this geopolitical issues. I mean, in the past, we have seen the Red Sea issue, which was there, which was put behind us. And then this morning, it was Iran, shooting missiles into Balochistan and Pakistan. So I think that is what shook the markets. But before that, overnight, we have seen that the global markets are down. So because of which the Nifty was showing a cut of 200 points to start off with. But then that increased because of this geopolitical issue which happened today. And to top that up, we also have the US Fed interest rate, which they are talking about now much later than what it was expected earlier. In fact, we were expecting it would happen in the first half of 24, but now it seems it will be possibly in the fourth quarter of 2024. You look at the China economic data, I mean, that was lower than expected. So I think that was another reason for disappointment. And to top all this, we had HDFC Bank earnings, commentary from the management, which I think, and the interaction which they had with the analysts and investors, I think that was a bit disappointing. And because of which we saw that major cut in HDFC Bank, which again, like you rightly said, it's about 14% of the Nifty, and it's close to, I think, about 41% of the bank Nifty. So the weightage is decently high, and that also weighed on the index overall. But then the question is whether we will see a further cut like this, because I mean, this sort of a cut, yes, I don't think too many people would have been shaken up very badly, because I mean, they made enough money in the last 18, 24 months. But in case we see similar cut for the next 2 or 3 days, I think that's when we could see some amount of panic from, these investors who are decently new to the markets. So that's got to be seen. So if the markets hold on for tomorrow, day after, then I suppose we would have seen this fall and then some bounce back from here. But a further cut from here could be quite deep.
All right, and I want to spend some time on what went on with HDFC Bank, because the numbers, at least the headline numbers, they look pretty much in line with, what the street was expecting. Right. But, looking under the hood, especially on the margin front and the LCR front, things are looking a little frothy for the company, isn't it?
Absolutely, because I mean, we thought that the issues which were coming up because of the merger with HDFC. I mean, we thought that would have been over as of last quarter, and this quarter could be a much better sort of a scenario. But now, from the discussion which the management had, it seems that the issues will continue possibly for the next 2 or 3 quarters, and they will have to increase their retail deposits, and that will surely come at a cost. And that cost will also weigh on the NIMs, which have been falling quite sharply. So, I mean, basically, on like whichever parameters you look at, I mean, because of which HDFC Bank was getting their premium valuation in the last 2 to 3 decades, I mean, that's gone for a toss, at least for the time being, and it's hopeful that they'll come back on track. But we were expecting them to come back on track this quarter, which is not happening. So I think it'll take a bit more of time. So I think we could see some further cut in HDFC Bank. But I mean, what I would say is, for a long-term investor, I think that'll be a good opportunity to buy at lower levels.
All right, and as you can see on your screen, sir, a lot of other banks also, took a big cut today. So do you think that this is a bank-specific problem, or can we expect similar issues in the quarterly results of other banks as well?
No, I think this was a bank-specific issue. I think, like I said, this was because of the mega merger which was there with HDFC, which has created this issue for HDFC Bank. I don't think you'll see similar issues as far as the other banks are concerned. But what I've been maintaining in the past, that as far as NIMs are concerned, I think we have seen that top. And clearly, getting more deposits from the retail for the banking sector is going to be a bit difficult, looking at the way the markets had performed, at least till yesterday. And a lot of savings were actually being deployed into the markets. So that was another challenge for the banking space. I think that will be there for the banking space overall. But then, like I said, HDFC has a different set of issues which should not be related to the rest of the banking space. And why did the other banks fall along with HDFC? Because you had the bank Nifty falling, and there are a lot of people who do arbitrage between. There are a lot of larger institutions who do arbitrage between bank Nifty and the individual banks. So I think because of that, we also saw the, like rest of the pack also falling.
All right, that's as much as we can talk about the banking bank, because we are running short of time. Asian Paints have also come out with the Q3 numbers. India's largest paint manufacturing company has in fact beaten the street's expectations as far as profitability and margins are concerned. However, revenue was slightly below what the street was expecting. I'll come to you in just a bit, sir, but let me just run our viewers through the numbers. The revenue for the quarter jumped about 5.4% on a year-on-year basis. That figure came in at around 1475 crore. That came in at 9104 crore for the quarter, for the December quarter, versus 8637 crore. However, it was slightly below the street's expectation that had pegged the number to come in somewhere close to the 9300 crore mark. Profit for the quarter jumped around 34.5% on a year-on-year basis. It came in at around 1475 crore versus 1095 crore, and it was also better than what the street was hoping for. Street had pegged the figure to come in somewhere around the 1400 crore mark. EBITDA, earnings before interest, tax, depreciation and amortization, on operating profit, that figure also jumped by about 27.6% on a year-on-year basis. Again, it came in at 2056 crore versus 1611 crore in the year ago period, and that also exceeded expectations. And margin, now that improved by about 390 basis points, coming in at 22.6% for the quarter gone by versus 18.7% in December quarter of FY23. Now, Mr. Balega, coming to you, what's your initial analysis of the numbers that came out from Asian Paints? I think revenue is a slight miss as far as the expectations were concerned, because the decorative segment underperformed. Is that your analysis as well, sir?
Yes, that's true. Because see, we were expecting the revenues to be better. Because if you're talking of margins, anyway, I think that was given because the way the raw material prices were coming down, it was clearly expected that the margins are going to improve. And this is year on year, clearly the improvement was decent. I mean, in line with what was expected. But as far as revenue is concerned, earlier we believed that the new brands which have come into play in the sector will not really affect Asian Paints as such, because Asian Paints is by far the largest in their segment. But looking at the revenues, it seems that there has been some effect because of the new brands which have come in. I think if that continues, it could be a reason for worry. But I don't think because of which, Asian Paints can crack from here. It'll possibly hold on, but may not really move up like what we had expected earlier. In fact, earlier I had a target of about 3900 for Asian Paints. But if this performance continues for another quarter or two, then maybe we'll have to review that.
All right, that's a view on Asian Paints. But sir, before we let you go, also wanted to touch on the IT stocks. Now, they were that was the only sector that gave positive returns in a day like this, where we saw a bloodbath on the street. IT stocks pretty much have rallied since the Q3 numbers of at least the top 4 companies have come out. We are also expecting the numbers from LTIMindtree to come down anytime soon. There is a bit of a turnaround in sentiment, but in your mind, are we, or is the IT sector out of the woods now?
See, in fact, I was expecting it to be out of the woods possibly from next quarter onwards, but it seems it has happened now. And again, the difference between IT and the rest of the pack which is there, the expectation from the investors and analysts was very low as far as IT is concerned. And when the commentary came, which was positive, you saw the results. Similarly, for the rest of the sectors which have moved up in the last 18-24 months, the expectations are high, and any sort of disappointment, can really push the stock down. We have seen that with HDFC Bank. I think that's, I would call that a trailer, and you could see that happening for a number of other stocks where the expectations are high.
And one final question from me. What would be your pecking order between the top 5 companies, your Wipro, HCL Tech, TCS, Infosys?
The pecking order would be TCS, HCL Tech, Infosys, and Wipro. These 4, my pecking order would be that.
Right, that's the view coming in from Mr. Amrish Balega. Sir, always a pleasure speaking to you. Thank you for giving us time here on News 9. But that's all we have in this edition of Last Tick. Stay tuned with us as we'll be back very shortly with Business Plus.
Ram's Ayodhya rebuilt. Ram Lala's Pran Pratishtha.